Recording in progress.
Good evening, students. Welcome back. So today we are going to start with different chapters. So a couple of chapters we plan to cover. So first of all, I have picked up this chapter, okay, which is about the prospective financial information and the assurance reports that we have in relation to controls at a service organization. So if you remember, service organization is one area for which we have already had some discussion, okay. But over here we are looking at a different perspective altogether. So it's not something which is a duplication, but you can say to a certain extent, because we understand what a service organization is, so that's why it will help you, right? And then we'll discuss about the report on compilation of pro forma financial information. Now pro forma appears to be a new thing, right? And this is not commonly seen except for the prospectus, because when you talk about a prospectus, that's where this pro forma is used, right? So we'll try to talk about all of these aspects one by one. Yeah, so these are the standards on assurance engagements only. So that's why you can say it's a level of assurance which is required to be provided by the practitioner. Okay, now moving on to the first area, which is about prospective financial information. Now, the first thing which arises is the understanding of prospective financial information. Now, what is this prospective financial information? What do you have therein? And if at all you are talking about its examination, then of course, what are the things you are required to look into it? Okay. Now, prospective means any information which is in relation to, say, future. So you can say something which is called as a forecast, or you can say a projection. So many a times, what do you do? As the management of the company, you are required to get into the projections. It may be required for different purposes. Now, projections are all about future information. Okay, so that's the most important aspect here. So let's try to understand about this prospective financial information first of all. So I'll just share one working file and we'll try to differentiate this prospective with the historical one. Okay, so now just a minute, I'll just share this working file. Right, so there we go. Historical financial information is something that we have already talked about. In fact, quite significantly, we have used this term historical, though we don't really focus upon that. Yes or no? So that's why when we will discuss both of them, you will get the understanding, you'll get to know the difference between them. So say for example, for an entity, financial statements have been prepared, okay, for which statutory audit will be performed, right? Now in such a case, what do you do? For the statutory audit, say the information that you audit is in relation to financial year 25-26. So you can say we are talking about the past period over here. Yes or no? So when you audit, you always audit for the past period in terms of the historical information. All right. So now, when you talk about this historical information, what is that for 25, 26? Right? Now, for this historical financial information, audit that we perform, what do you call it as? So that's the term that we use, statutory audit. Yes or no? Yeah. So we use the term statutory audit. Correct. Now say today we are on 31st March 2026. Okay. Or say for example, we are somewhere in 26, 27, and you'll be thinking that of course we are in 26, 27 only. But I'm just saying, let's suppose we are not talking about the past period. Let's suppose we are talking about the future period. Say on 31st March 2026. What do? You are required as a management. I'm looking at it from the management's perspective right now. Now you are looking at the future period as the management of the company. Yes or no? Right? Now, why is that required? Let's suppose that is required by some of the investors, say bankers, okay, or maybe for internal purposes it's required by the management, or maybe at times for audit purposes it's required by the management. Okay. Now in this case, when we talk about historical financial information, what is the basis for that? The transactions which have been executed. Yes or no? The documents which are there, agreements which are in place, invoices, all of this information is available, you can say, as a supporting information, or you can say that's the backup, or that's the basis, you can say. So now whether we record it as per any particular gap, that's not the point. So whichever gap we apply, we are saying it's all about transactions which are already executed. So do we need to think about it? Answer is no, because it's already there. But let's imagine that if, let's suppose, we are on 31st March 2026, and now we need to think about what is going to be the, say, revenue for 26, 27. What are going to be the expenses for 26, 27? Correct. So how do you go about it? Because sales have not yet occurred. Yeah. So all of these things are going to arise in future. Right. Now for this, what do you need? That is where the management will need assumptions. Right. So that's where the role of assumptions will come into picture. So management will have to think through as to, what is the revenue they will be able to generate in future. What are the expenses they will be incurring in future? Okay. Now, can we say it's going to be the exact amount? Answer is no. So that's what you call as prospective one, right? So that's what you call as prospective one. Okay. Now, in case of prospective, what do you have? You have the information in relation to the future, and that's where a very important aspect happens to be the assumptions. Okay, so this becomes extremely important for one to look into assumptions. Why? Because without the assumptions, will you be able to draw the numbers for 26, 27, or let's suppose for 27, 28? Yeah, so for whatever period you require that. So it's not something that you will have only for 1 year. Maybe for the next 5 years you need this information. Yes or no? Or maybe for next 3 years you need this information. Again, the period is not defined, so that will only be dependent on the requirements of the company. Understood? Yeah. So now this is what you call as prospective one. Okay. Wherein we looked at some examples as to what all things you'll have in case of prospective. Right. So let's read this definition once again with the understanding we just obtained. Prospective financial information is the financial information which is based on assumptions about the events that may occur in future. Yeah. And possible actions by an entity. Because it's all anticipation. Correct? Now over here, to say 100% accuracy is not possible. It's going to be quite subjective. And of course, significant judgment will be required to be made in this case. Right? Now, this prospective financial information, now what are the examples you can have for this? Say it's about a forecast, or it's about a projection, or it could be a combination of both. 1 year or 5 year projections or 3 years projections, right? Now, in this case, the most important aspect which the auditor requires, or you can say the practitioner requires, will be what? Assumptions. Yeah. See, the assumptions which the management will make, they are going to be important. Correct? And that's why when we are required to examine that, so what do you have? So you can say there are two things you can always look at. Let's suppose you happen to be a practitioner and you are required to examine the P&L for the next 3 years. Okay. Now let's think about it. What do you have in case of that P&L? You can say there will be an Excel file, right, which will be in the shape of P&L. Correct? So in that Excel file, what do? You can check the formulas, you can check the calculations. Yes or no? Otherwise, what do you have other than the calculations in that Excel file? Do you have something? Answer is no, except for one point. What is that? Assumptions. Because for the management to draw the numbers for the next 3 years, next 1 year, or for the future period, what do they need? They need the assumptions. Correct? So that will become the basis for the numbers to be recorded there. Right? Okay. Now, when you talk about this standard on assurance engagement, okay, now comes the point that what is going to be the responsibility on the part of management and of course on the part of the practitioner. So there again, you can say it's similar to what you have in case of financial statements. So when the financial statements are prepared, what do you have? It's the management which is responsible for that. So same goes over here. Here again, it's the management that will be responsible for the presentation of any such prospective financial information. Okay. Now, it's not only about putting down the numbers in an Excel file, it's also about the basis of preparation. Now, who will have that? It's the management only, because the management would have prepared that. And the assumptions. So when you say the basis will always be assumptions, so where do the assumptions come from? So those are again thought through by the management only. Yeah, so that's the thing which the management will be required to do. So they will have to think through as to what are going to be the assumptions therein. Correct? Yeah. So now, for the management, all of these aspects are important. Okay. Now let's talk about the audit side. Now, when you talk about audit side, because it's all in relation to the examination. So now the question arises, what is required to be done by the auditor of this prospective financial information? See, over here, actually, there is nothing other than assumptions. If we look at it, so as we discussed, an auditor can only check two things. One, of course, the calculations, yeah, which is all going to be, you can say, more of clerical in nature, wherein you can say judgment is not required. Yes or no? Of course, that's an important part for the verification that cannot be ignored. But over there is no role of any sort of judgment. Now, that's what you see in case of assumptions. Because other than these calculations, the auditor will also require to check two things. Assumptions. Now, for assumptions, auditor will have to first of all understand the thought process of the management. Yes or no? Yeah. Because only when the auditor will be able to understand the thought process, auditor will be able to think about it as to whether that is really appropriate or not. Yeah. So that's why understanding of what all assumptions have been used and why such assumptions have been used becomes important, right? So that becomes important. Auditor will have to understand what is the thought process, what is the judgment which the management has applied. And accordingly, auditor will also be required to think about it, audit that as to whether those assumptions are logical or not. Okay. Now, sometimes what may happen is, say the entity has used a particular gap, or you can say accounting policies for the preparation of historical financial information. Okay. So if you go back to our example, over there we discussed what is going to be the historical financial information, right? Now that's where one aspect which the auditor can always consider. Let's try to understand that, because that can really help the auditor in checking as to whether some of these assumptions are really logical or not. Right? Now, what is that? So let's try to understand that. So when you are looking at say 25, 26, okay, say we are talking about 25, 26. Now let's suppose over here management has considered certain accounting policies. So what should the management do? Management should apply similar sort of accounting policies over here as well. Yes or no? Yeah. So that's one part which the auditor will be able to easily verify. Okay. Next, sometimes what may happen is that during the course of audit, some of these assumptions which the management will use is based on past pattern. You can say historical data becomes the basis. Say revenue has been growing at 10% over the years, over the last 5 years. So let's suppose management is carrying the same assumption. It can always be lower than that, it can always be higher than that, but the management will provide a justification even for the same percentage. Management will provide a justification because to have that 10% over the years doesn't mean that the entity will be able to continue with the 10%. Yes or no? But we can say that it can become quite easy for the auditor to verify this period on the basis of what? Past pattern. Okay. Plus, let's suppose when the examination is required to be performed. So during this period, already half an year is gone by. Okay. Let's suppose, say we are on 30th September 2026. Now, in this case, what should the management do? While preparing the prospective numbers for 26-27, because the period up to 30th September 26 is already past period. So that's why what should happen? This period should be the one which is on actual basis. Yeah. Let's suppose the management has considered some basis. And if you look at the numbers which are actual and they are not in line with what the management has projected, so what will happen? You will have to ask the management what is the reason for such a variance. Yes or no? Yeah. So that becomes important for the management to look into it, and therefore the auditor to also look into it, whether the numbers in the projected period are consistent with the past data or not. Yes or no? Yeah. So that's very, very important, huh? Right? Now, moving further. Now let's talk about some of these engagement formalities. Yeah, so what are the considerations which the auditor will have to be in considering? So of course the basis, right? And some of those compliances in terms of eligibility, because it's an examination. So that's why same level of consideration in relation to the eligibility and all those considerations will have to be looked at by the auditor over here, right? Now, examination procedures, I think we have already talked about. Okay. Now what will be the, you can say a format, or you can say the outlook in respect of the report over here. So of course, over here we start with the title, addressee, then the identification of prospective financial information. So means whether it's for 26, 27, 27, 28, or for the next 3 years. So that's what you specify. So that one gets to understand what is the underlying information which is getting examined. Correct? Then reference to the auditing standards, of course, that becomes important. Management's responsibility. Okay. Now, because it's a prospective one, so you can say to a certain extent, what do you have? This is also meant for a specified purpose. Yes or no? So it's not something which is similar to, you can say, financial statements, which will go out to the regulator and which are general purpose. No, it's not that. So that's why over here, what do you find? It's meant for a specified users, that category, and for a specific purpose as well. Right? So that's why for an auditor, it becomes important to give such a restriction. Again, similar to the one that we talked about in the previous session as well. Okay. Then, because it's an assurance engagement, so the level of assurance, what is that? It's on a test check basis, right? So do you do 100%? No, again, no. So that's why this needs to be specified that the assurance level is what. So a statement of negative assurance as to whether the assumptions provide a reasonable basis for the prospective financial information. Opinion as to whether the financial information is prepared properly on the basis of assumptions and whatever is the relevant financial reporting framework. Okay. If at all there are caveats concerning the achievability of results, which are indicated by the prospective financial information, and then of course the auditor will sign it off, yeah, giving the date and the place, similar to what you see in case of any other report, right? Yeah. So now moving on to the next standard on assurance engagement, 3402. Okay. So now we'll talk about assurance reports on controls at a service organization. Now, if you remember, when we talked about a service organization, okay, so there were few concepts that we discussed. There will be a user entity, there will be a service entity, there will be an auditor of the user entity, and there will be an auditor of the service entity. And that's where we also discussed that auditor of the user entity will need to perform some procedures in relation to this service entity. Why? You can say a certain process of the user entity is being handled by whom? Service entity, right? And if let's suppose auditor of user entity has to audit the user entity in respect of all of its processes, so the process which is there with the service entity, how do you look at it? by looking at what the service entity is doing. So no, yeah, so that's how you'll go about it. Okay. And that's where we also discussed that the user entity's auditor may require a report from the auditor of service entity in respect of the controls, in respect of whether the controls are operating in an effective manner or not. Correct? Right? Why? Because that's how the auditor of user entity will be able to then complete the audit process. Yeah. So let's just revisit this term service entity. Service organization refers to a third party organization that provides services to user entities. Say A Limited has outsourced payroll services to B Limited. So A is what? Service user entity. B is what? Service entity. Right? Now, for the user auditor, for the service auditor, the roles and responsibilities that they play, they are quite specific. Correct? So they are all in relation to the entities they are auditing. So is it a mix-up? Answer is no. It's not really a mix-up. Okay. So now what are the objectives of a service auditor in accordance with this standard on assurance engagement? Let's try to understand. Yeah, so Manish has a query. Manish is asking, this assurance report is prepared by user auditor or the service auditor and given to whom? Please clarify. So sure. So we'll discuss all of these aspects, right? See, what is the objective of service auditor? To obtain reasonable assurance about whether in all material respects service organization's description of its system fairly presents the system as designed and implemented. Controls related to service organization, they are again going on fine, right? So I'm just trying to look at this very layman term. And that's where, if you remember, we talked about two types of reports, type 1, type 2. Let's revisit this. Type 1 is the one which will include service organization's description of its system, written assertion by service organization that in all material respects, description fairly presents service organization system as designed and implemented. Controls related to the service organization, okay, they were suitably designed, and service auditor's assurance report that conveys reasonable assurance about the matters referred to in this point number 2. Okay, when you talk about this type 2, so that's where you see it's you can say a bit advanced, covers some more aspects, which will also be talking about whether the controls are operating effectively throughout the period, which is not there in service organizations type 1 report, and conveys reasonable assurance about the methods, includes a description of the test of control and results thereof. Yeah. Now this may vary. Yeah? So this may vary again depending on the requirements of the user auditor as to what is it the user auditor will require. But coming back to the question which Manish just asked, let's try to understand this as to who is doing this assurance engagement, who is providing the report. Okay. Now let's look at this example. Say we are talking about A Limited. It's the user entity. And then we have this B Limited. It's the service entity. Correct? Okay. Now we have two auditors, user auditor. Similarly, we have this auditor of service entity. I think if you understand the structure, you will get the clarity. Okay. Now, what is the entity under audit? So we are talking about A Limited right now. So A is the entity for which we are talking about audit. Okay. So the audit is being discussed in relation to A. But there's a problem. One part, or you can say one process of A is looked at by whom? B. So that's why what will user auditor require? User auditor will require to audit this payroll as well. So there are two ways to go about it. Either the user auditor will audit payroll himself completely, or will require this report from service entity auditor. So that's why when you talk about these reports, who is providing? Service entity auditor. Understood? Now, the next question arises that let's suppose after the service entity auditor has provided these reports, on the top of it, in addition to that, even after that, if let's suppose user auditor wants to audit something, so of course that can always be done. See, we are not putting any scope limitation on the part of the user auditor by providing such a report to him. Understood? Yeah. So this will not act as a limitation. So that's not the purpose at all. Right? Yeah. So I'm just hoping, Manish, you are clear on this as to what is done by whom, what is being provided by whom. Clear? All right. So now moving back. Now, because again, we are talking about a service organization and the assurance procedures around it. So, how do you begin? Right? Yeah, so that's correct, Manish. How do you begin? Ethical requirements will again be important. Okay. Now, even if the service auditor is auditing something, performing certain procedures, this underlying information, whether it's in relation to A or B, who is responsible for that? It's the management of B. Yes or no? So that's why management's responsibilities as to what do they include, what do they cover, they all become important on the part of the service auditor to look at. Okay. and somewhere you will also see that specified, right? Yeah. So now, of course, when the service auditor will have to go approach the audit, various procedures will have to be performed. Planning, see, because it's all about examination. So the processes will have to be understood. Organizations, business will have to be understood. There are a lot of factors. Yeah. Because without that, how do you plan the procedures? Yes or no? Because understanding of the controls will be required. Only then you go and perform the procedures around the control. Correct? So all of those aspects therefore become important, right? Now, what you have in terms of report, again, you'll have similar sort of requirements. A title, addressee, identification of service organization's description of its system, service organization's assertion. Again, that will vary as to whether it's a type 1 or type 2 report. Okay. But that needs to be specified therein, right? Identification of the criteria, some of these control objectives, some of these control environment, all of them become important. Statement that the report, and in case of a type 2 report, description of the test of controls are intended only for user entities and their auditors who have a sufficient understanding to consider it, along with other information, including information about controls operated by user entities themselves. Yeah. Then, of course, management's responsibility. That it's the management of service entity that is responsible for preparation, design, controls, and all of these aspects. Then, of course, the auditor's responsibility, that it's all about expressing an opinion on service organizations description on the design of controls related to control objectives. Okay. On the operating effectiveness, when you talk about type 2 report. Okay. Now, some of these elements you can say are going to be accordingly quite standardized. And of course, depending on the outcome that you have, if at all there are any sort of modifications, so that will also have to be incorporated there. Clear? Now, moving on to this third aspect, pro forma. Now, this is not something which is you see commonly. Okay, so that's why I think first of all, similar to what you did in case of prospective financial information, now we will also discuss about pro forma financial information. Okay, so now what is that? Right? Pro forma refers to financial information shown together with adjustments to illustrate the impact of an event or transaction on unadjusted financial information, as if the event had occurred or the transaction had been undertaken at an earlier date selected for the purposes of illustration. It's something you normally use in the offer documents. Okay. Now, what is the objective? Let's try to understand this, because once you understand what the pro forma is, automatically you will be able to draft the procedures around that as well, right? Again, it is similar to what you see in case of projections. So let's suppose we are talking about A Limited. Okay. Now let's suppose A Limited is planning an acquisition. Now this acquisition is going to happen in future, right? So if you look at 26, 27, say sometime in 26, 27, this is going to happen in future. We are in 25, 26, for which the financial statement is drawn. So you can say this is the historical one. Okay. So the management will prepare this historical one, correct? Now, there's an event which is going to take place in future. Acquisition, say, of a business, of certain assets, whatever is that, right? Now, what is going to happen if, let's suppose, this acquisition takes place? How the P&L is going to change, how the balance sheet numbers are going to change. If, let's suppose, we assume, now it's an assumption, that this, let's suppose, takes place during this year itself. Okay. Now, actually, that has not happened. It's an assumption you're taking. And if, let's suppose, you assume that, what will happen? Numbers will also change accordingly, right? So the numbers that you redraw basis this assumption, you can say which you are preponing or which has actually not happened, which you are assuming, because we don't know whether it will happen in the future or not. So that's a plan. Okay. So this is what you call as pro forma. Means the number that you get basis that. That's what you call as pro forma. Right? Clear on this? Now what a pro forma is. Now once again, when you talk about pro forma, an immediate consideration will arise. What is that? That for this pro forma, the numbers that you draw, are they actual numbers? Are they based on historical financial information? Answer is no. So that's why, what did you do? You assumed, correct? You assumed as if this has taken place today, right? Now we have looked at the management's perspective. So let's suppose if you look at it from the perspective of the auditor, I think it will become quite easier to think about the auditor's procedures now. Yes or no? Okay. As to what all procedures an auditor will have to then perform, right? Now, what are the steps you will see? Because it's an insurance engagement, so of course you'll start with the engagement acceptance formalities. Planning is something we have discussed is required to be in place anyways for each and every type of engagement that you have, right? Very, very important to be in place. Correct? And then, of course, you will be thinking about the procedures which need to be planned. And that's where one of the most important procedure happens to be what? This assumption. Okay, this entire situation. Why? Because other than that, what do you have? You have all of these calculations only, huh? Or maybe, of course, the criteria which we'll use for presentation. Yes or no? Yeah, because the outlook which you are going to provide, so what is going to become the basis for that? All those aspects will also be important for the auditor to look into. Correct? Yeah. Now, what are going to be the elements of the report therein? One, title that clearly indicates report is independent assurance. So the independence is a must. Addressee, similar one. Introductory para. So of course you'll identify the performer, financial information. What is that? Right? Source from which unadjusted financial information has been extracted. Whether or not an audit or review report on such a source has been published. Period covered. The reference to applicable criteria means what is the criteria which has been used. Management's responsibility. And then, of course, practitioner's responsibility. Okay. And then, of course, you move on to the opinion which is provided. And here again, what do you have? You may have similar sort of considerations in terms of the opinion as to, whether the opinion is going to be modified or not. So all sort of considerations will also be there in this case. Right? Okay. All right. So now I think before we move further, we will look at some questions and maybe we can just take a short break now for 5 minutes and then we'll continue. Huh? Okay. So Vivek, we can take a break for 5 minutes now. Vivek, we can take a break for 5 minutes. Huh? Vivek, we can continue. All right. So now moving on to the questions. So we'll pick up some questions first, basis this, and then we'll move on to the next chapter. Okay. So let's look at this. Move on to the question. Just give me a minute. Okay. So there we go. Company has approached chartered accountant, okay, Hemant, for an assurance report in respect of prospective financial information of a project. Okay, so that's what the company has done. So basically, we are talking about prospective financial information. Now, it's in relation to a project. On going through the project details, it is noticed that depreciation reflected in proposed fixed assets to be acquired. Yeah, so what the management has done is they've charged depreciation, and because it's all prospective, so they've assumed that company will acquire some PP. Okay, so that's what the company has assumed. Proposed fixed assets to be acquired. Okay, so this depreciation has been calculated in accordance with the provisions of income tax. But when you draw the financial information, okay, so for calculating depreciation, do you consider the provisions of income tax? Answer is no. Why? Because that's where you use useful life. And that's estimated. Now we don't know whether it's a specific requirement to use the income tax provisions, or you can say the rates as per income tax. We'll have to find out. But it appears it's not something in line with what is required to be done. So that's why they are saying no disclosure are made in this respect. How the matter should be proceeded. Okay, so let's look at this. In such type of engagements, what do you have? In such type of engagements, it's the duty of professional accountant, okay, to see that prospective financial information is actually based on a consistent basis. That's extremely important. Why? Because if the consistency is missing, so how do you really go about it? How do you assume that the assumptions are in line with what are the requirements of financial reporting framework? Okay, so you can say one concern is about the consistency. Something which is done in the historical financial statements in terms of the accounting policies which have been considered there. They don't seem to be used, correct? So you can say a different set of accounting principles have been used. So clearly that's inappropriate. Yes or no? So for a company, what do you find? Historical financial statements are prepared considering requirements of Companies Act. And that's how the depreciation is also charged. Right? And that's how you see the depreciation is also charged. So depreciation is calculated accordingly. However, in the given situation, depreciation has been calculated in accordance with income tax, which is inconsistent with what is there in the historical financials information. So therefore, what do you call it as? Clearly, the prospect information is not proper. Yeah, so that's clear. The fact that the projection has not been prepared on a consistent basis with historical financial statements using the appropriate set of accounting principles. This needs to be stated. Further, when the presentation and disclosures are not adequate, so what do? You will look at the materiality and you will therefore decide about the modification. Yes or no? Yeah. So that's the way to go about it. Correct? Right? Next, let's look at the next one. Manish is asking what it is not pervasive. Yeah, so that's what you'll have to evaluate. Okay. So on the basis of the information that we have, we don't know whether it is pervasive or not. Correct? So one will have to think through. Right? And accordingly, you will be able to comment. That's why we are talking about both the things, qualified or adverse. Right? That's why you see this or adverse. Okay. Yeah. Now, moving on to the next one. Bansi Group is a leading institution running prestigious postgraduate courses in the field of management. So they are in the business of education. Right? Its financial statements are audited before the start of this academic session. Board of the institution had outsourced its entire process of inviting student applications. Submission of applications, collection of application fee, okay, and such matters to a third company. Easy Solutions Limited. So in this case, what do you call this Easy Solutions Limited? Service organization. Yes or no? Yeah. So 1C group is what? User entity. Easy solution is what? Service organization. Then we have the auditor of user entity. So this is user entity auditor. And then we'll also have the auditors of service entity. Right? Now, auditors of 1C group means this user entity auditor want to be sure about design and operating effectiveness of controls at Easy Solution Limited. So that's the requirement of the auditors of user entity. First, what should be the nature of report to be provided by auditors of Easy Solution? So these are the, you can say, okay, so the first question is, what will be the nature of report they will have to provide? Right. If you look at the requirements of the standard on assurance engagement 3402. Okay, so I think quite clear. Huh? So let's look at this. See, in this case, auditors of 1C group means user entity auditor. They want to be sure about design and operating effectiveness of controls at Easy Solutions, which is a service organization. And that service organization is providing services to user entity 1C group. Considering the requirements, so what's the specific requirement if you look at it? When you talk about design and operating effectiveness of the controls, where do you get that? Type 2. So type 2 is the report on the description, design and operating effectiveness of controls. Right? So therefore, auditors of Easy Solutions means service entity auditor. Correct? Service entity auditor should provide such a report giving assurance on these matters. It should also include details of test of details. Sorry, test of controls. So that's something you have in case of type 2 report. Correct? So that's the thing you'll have in case of type 2 report. Right? See, Manish, when you talk about the way you will answer it in the exam, see, in case of exam, I would say few things become important. Okay, of course, we are trying to understand the approach we need to consider in case of exam. Now, your query is, I think, very relevant and important. Depending on the weightage, you will always approach it, right? Now, what are the few things which become important? See, it's not about the length always. Okay, so you should not be thinking that the length is too short. Important thing is whether the required content has been included there. Okay, so over here, what are the things you need to top up? First, SAE you will refer. Okay, so that's one. Then, depending on the weightage, again, you will give the guidance. So you can always talk about what the guidance SAE provides. So you can say that's going to be a second part. Okay. Now using the technical literature, okay, which is your part number 2. So this is your part number 2. What do? You will analyze the case scenario, right? So you can say first of all you are giving the reference, okay, which anyways is going to be a part of the technical guidance. And then third step will be the analysis. Now, how do you do the analysis? Using the technical literature you have given in the second part, you will discuss the case scenario and you will give as to what is your view, what is required to be done. And then, of course, to conclude, which you can always do at the beginning, which always looks appropriate, will be to give a conclusion. You can always start with that. Means what is the final outcome you are suggesting. Now, for doing this, if let's suppose your length is good enough or not in terms of your thought process. Okay. So now see the way it's required to be covered. Please understand that the study is not giving you the weightage. Understood? Yeah. So that's why I'm saying so you need to compare as to which all things you are required to do and when. Let's suppose it's a 2 marks. Then of course you'll not get into too much details. And you should not do that. Right? So accordingly you will approach it and accordingly you'll have to tailor it. Right? But I would suggest the same approach you should consider for all. Yeah, quite standardized. Clear? So let's look at the next one. Management of S Limited requests you to accept an engagement to report on compilation of pro forma financial information. Okay. Now, considering the requirements of SAE 3420, what factors will you consider regarding the company acknowledging and understanding its responsibility in this matter before accepting the engagement. Okay, so let's look at this. What are the responsibilities? Company's responsibility has to be acknowledged for the following matters. One, adequately disclosing and describing applicable criteria to the intended users if these are not publicly available. Correct. Compiling the pro forma financial information on the basis of applicable criteria. Providing the practitioner with access to all information, including when needed for the purposes of engagement, information of the acquiree in a business combination. Again, that depends. Okay, the situation or the event which is going to be there, such as records, documentation, other material relevant to evaluating whether the pro forma financial information has been compiled on the basis of applicable criteria. See, the applicable criteria becomes important. So that needs to be explained, right? So we are looking at it from the perspective of management here. Correct. Additional information that the practitioner may request. Okay, for the purposes of this engagement. Access to those within the entity and entity's advisors from whom practitioner determines it necessary to obtain the evidence relating to evaluating whether pro forma financial information has been compiled on the basis of applicable criteria. When needed for the purposes of engagement, access to appropriate individuals. Right? Clear on this? Now, moving further. Okay, so now what we will do is, I think we have this case scenario. Okay, so now just a minute. Let me just move on to this case scenario. Right, so let's look at this. Below is the given draft text of the report on examination of prospective financial information. So we are talking about report on prospective financial information. So that's the subject matter of our discussion, right? What's the name of the company? Top Edge Limited. In relation to company's upcoming project prepared by a staff member in a CA firm unfamiliar with drafting such reports. So competency seems to be the issue, or maybe the experience. We don't know. We'll have to find out. Report has been drafted in a casual manner and may consist of omissions and errors. Okay. First, then you look at the title. Report on examination of prospective financial information. It's addressed to the board of directors of the company. Now, there we go. Now the report starts. Okay. We have examined projection of upcoming project to come up at Ratnagiri of Top Edge Limited for the period from April 24 to March 30. as it's given in the prospective financial information from page 1 to 250. Okay. In accordance with standard on assurance engagement 3400, which talks about examination of prospective financial information. Okay. Preparation and presentation of the projection is the responsibility of the management and has been approved by the board of directors of the company. Right. Next, our responsibility is to examine evidence supporting the assumptions, excluding the hypothetical assumption, other information which is there in the prospective financial information. Okay. Now, all of this which you read, actually, it's a part of the report. Yeah, so that's something you need to remember, right? Then, projection has been prepared using a set of assumptions. Okay. That include hypothetical assumptions about future events and management's actions that are not necessarily expected to occur. We have carried out our examination of the prospective financial information thoroughly. So this is what the auditor is writing. Okay. Further, in our opinion, projection is properly prepared on the basis of assumptions as set out in note 1 to 50. Okay. And they are on a consistent basis with historical financial statements using appropriate accounting principles. Even if the events anticipated under the hypothetical assumptions described above occur, actual results are still likely to be different from the projection since other anticipated events frequently do not occur as expected and the variation may be material. Okay. So then it's signed off by the firm. Signature, designation, membership number are given. Right. So that's the thing you have in case of report. Now over here, actually, if you try to see, this case study is trying to test your drafting ability. Yes or no? Yeah. The way you draft a report, that's what is going to be tested. Correct? Why? Because in future, as an auditor, this drafting is something which is significantly required. Okay. So now some of the questions that will follow. Over there, you are required to check, comment whether there are any errors in the drafted report or not. Yeah. So one, whose responsibility is to list out assumptions underlying the prospective financial information? I think this is quite clear, simple one. It's the professional accountant who is issuing the report on prospective financial information. Auditor of the company issuing a report on prospective financial information, management of the company, banker of the company. I think, as we discussed, it's quite a simple one. Correct? Next, which of the following statements is most appropriate regarding use of prospective financial information to be included in such a report? Intended use of projection is required to be disclosed. It is further necessary to caution the users regarding inappropriateness of projections for other purposes. Okay. It is discretionary to state intended use of projection in such a report. Intended use of projection is required to be disclosed. It is not necessary to caution the users regarding inappropriateness of projections for other purposes. It is the prerogative of the management to use the report in the manner it deems fit. Now, in this case, which one do you think is the right answer? I think again, very clearly it has to be one. It has to be A. Yeah, because to say that it's not necessary will be wrong. Correct? So it's necessary to caution the users regarding inappropriateness of projections for other purposes. Important thing, huh? Correct? Next. Which of the following statements is most appropriate regarding examination of prospective financial information by a chartered accountant in accordance with SAE 3400? First, accuracy of projections is vouched for based upon performing procedures thoroughly. Projections can go haywire. It depends upon the professional judgment of chartered accountant to vouch for accuracy of projections. Accuracy of the projections is not at all vouched for in an assurance report on prospective financial information. Matter of accuracy of projections or otherwise is not the domain of such an examination. Therefore, there is no reporting requirement under SAE 3400. Yeah. So, in this case, what is the right answer? The right answer has to be C. Accuracy of projections is not at all vouched for in an assurance report on. No, so I think this is not the correct one. So it has to be A1, right? Okay, now, which of the following statements is most appropriate regarding UDIN in the context of examination of prospective financial information by a chartered accountant? I think UDIN is one area which is extremely important. Now, it is mandatory to state UDIN, desirable to state UDIN, not required to state UDIN because it's not audit, not required to state UDIN as it's not an engagement related to historical financial information. So over here, what is the correct one? I think clearly it has to be A. Yeah, so the one that you will do for UDIN is something which is mandatory. Yes or no? Yeah, so it's something which is mandatory, right? So now let's look at some more questions. Practitioner shall not accept the compilation engagement unless practitioner has agreed to the terms of the engagement with the management and engaging party if different. In view of the above, so now I think this is the other one. So compilation is something that we have already looked at. So I'll not really get onto that. So let's look at this next one. Or maybe for practice purposes, we can do this. There's no harm, right? Okay. Mention the responsibilities of the management to be agreed on for the compilation engagement. Right. So let's look at this. So the practitioner shall not accept the compilation engagement unless practitioner has agreed to the terms of the engagement and engaging party if different. Okay, so that's one. Next, in accordance with SRS 4400, responsibilities of the management, what are those? So let's look at this. What are the responsibilities of the management? Financial information and for the preparation and presentation thereof in accordance with financial reporting framework that is acceptable in view of intended use of financial information and intended uses. So that's one. Design, implementation, maintenance of such internal control as the management determines is necessary to enable the preparation of financial statements that are free from material misstatement. Okay. Accuracy and completeness of the records, documents, explanations, other information provided by the management for the compilation and okay, judgments needed in preparation and presentation of financial information, including those for which practitioner may provide assistance in the course of compilation. Right? Next, let's look at this. Star Limited has outsourced its payroll processing functions to a service organization. Okay. So this is the user entity. And there's a service organization. What is that? Little Solutions is the service organization. Okay. Little Solutions is responsible for accurate preparation of payrolls, timely remittance of statutory dues to government authorities on behalf of the company. Okay. Little Solutions controls related to timely remittance of payroll deductions to the government authorities are relevant to the company as late remittances could result in interest and the penalties resulting in liabilities for the company. Right? Now, auditors of Star Limited. User entity auditor. They want to be sure about description, design and operating effectiveness of controls at Little Solutions means service organization throughout the year. In this regard, they require an assurance report from the auditors of service organization. Okay, now why the auditors of user entity? Star is what? User entity. Why the auditors of Star Limited user entity require an assurance report from the auditors of service organization. So that's one. Why is that required? Which engagement and quality control standard casts such a kind of responsibility upon the auditor? Means this engagement and quality control standard you need to specify. So sometimes you see that is given in the question. Over here you need to specify. Okay, so which one is that? Which type of report should be provided by auditors of service organization? Right? Means what is going to be the type of report? Justify with reasons. So the type of report you need to specify. So why the auditors require which engagement and quality control standard? Which type of report is involved here? Right? Now, state the matters on which opinion is to be provided by the auditors. So let's look at this. Now, when the user entity uses the services of a service organization, objectives of auditor of user entity, what are those? To obtain an understanding of nature and significance of services provided by service organization and their effect on the user entity's internal control relevant to the audit, sufficient to identify and assess the risk of material misstatement. Okay. And to design and perform audit procedures responsive to those risks. Okay. Now, therefore, what do you have? It's in line with above requirements that auditors of Star Limited require an assurance report from service entities auditor. Right? Now, in accordance with, so this is 3402. In accordance with the requirements of SAE 3402, service entities auditor should provide type 2 report. Because some of the requirements which are specified, where do you get that? Type 2 report. So that's where you get that. Correct? As the auditors of Star Limited want to be sure about description, design, operating effectiveness of controls for the service organization throughout the year, and type 2 report deals with such matters. So type 2 report should be provided by auditors of service entity. It's a report on description, design and operating effectiveness of controls. Yeah. Whereas type 1 report is a report on description and design and operating controls at a service organization. See, the opinion of the auditors of service entity would state, now what do they have? Description fairly present service organization systems that had been designed, implemented throughout the period. Next, controls were suitably designed throughout the specified period, and controls tested, which were those necessary to provide reasonable assurance, were achieved and operated effectively. Now, this is what you see in case of type 2, right? Clear on this? Yeah. All right. So now let's look at some more questions. Just give me a minute and I'll just move on to some more questions. Okay, so there we go. Mr. Vineet, an auditor has been approached by KUB Limited to examine prospective financial information. What factors should an auditor consider before accepting an engagement to examine prospective financial information? And under what conditions should the auditor decline or withdraw from such an engagement? Additionally, what steps should be taken to formalize the terms? So let's look at this. See, before accepting an engagement in relation to what? Examination of prospective financial information, the auditor would consider intended use of the information, whether the information will be for general or limited distribution, nature of the assumptions, that is, whether they are best estimates or hypothetical assumptions, elements to be included in the information, period covered. Okay. Auditor should not accept or should withdraw from an engagement when the assumptions are clearly unrealistic or when the auditor believes prospective financial information will be inappropriate. Okay. So auditor should consider the extent to which reliance on entities' historical financial information is justified. So in this case, to formalize the terms, it's essential to agree on terms with the client by sending an engagement letter. So that's what you do anyways. So for various engagements which you come across, correct? So I think now what we can do is, again, we can take a short break for 5 minutes, right? So Vivek, Manish, we can take a break for 5 minutes. Huh? All right. All right, so now moving further, say 3400 explains prospective financial information can take the form of a forecast, projection, or a combination of both, right? In this context, how do you differentiate a forecast from a projection? That's one. Also provide an example for the same. Additionally, explain the nature of assurance provided by the practitioner regarding prospective financial information. Okay, so let's look at this. So when we talk about prospective financial information, so we discussed that this can be in the form of a forecast, projection, or combination of both. Okay, 1 year forecast plus 5 year projection. Now, what do you mean by forecast? Forecast means prospective financial information prepared on the basis of assumptions as to future events which the management expects to take place and actions management expects to take as of the date information is prepared. So you can have best estimate assumptions, an assumption that reflects anticipated experience with no provision for risk of adverse deviation. Okay. Now, to take an example, we can say in the present market conditions, supply availability, historical buying patterns, seasonal trends. Okay. CFO of X Limited expects sale to increase by 5% over the next quarter. Right? Now, this 5% sales increase is his financial forecast. Right? Okay. Now, projection means, so when you talk about projection, so it means prospective financial information which is prepared on the basis of one, hypothetical assumptions about future events, management actions, which are not necessarily expected to take place, such as when some entities are in a startup phase or considering a major change in the nature of operations, or mixed of best estimate and hypothetical assumptions, imagined or suggested. So to take an example for this, what do you have? X Limited may project course of action. Okay, to take when one or more hypothetical situations arise, such as creating a new product to meet the demand of expected market growth as a result of assuming the possibility of different events occurring. Financial projections typically serve as outline for evaluating the desired outcomes, which X Limited expects to see, including its financial, cash flow, operational outcomes. Okay. Now, when you talk about prospective financial information, So it relates to events and actions that have not yet occurred and might not occur. While evidence may be available to support the assumptions on which the prospective financial information is based, such evidence is itself generally future oriented and therefore speculative in nature, which is distinct from what? Evidence which is available in historical financial information when you examine that. Okay, over here, what do you have? Future oriented, speculative. So that's the feature you'll have, correct? Therefore, an opinion as to whether the results shown in the prospective financial information will be achieved cannot be expressed. Yeah, okay. All right, so now what we will do is we'll just move on to this next uh, area. So let me just get onto that document now. Review, right? So now we'll talk about review of financial information. What is it you do in case of review? How do you really go about this review and how is it different from assurance? I think once you have understanding around these areas, you'll automatically get the clarity around what a review is. Okay, now let me just share this with you. There are a couple of standards we are going to look at. And because it's a review, so that's why you call it a standard on review engagement. Okay, so you may have SRE 2400, which is about engagement to review historical financial statements. Or it could be SRE 2410, which is a review of interim financial information. Okay. So first of all, understand about the meaning of review. Why? Because once you get the clarity on what a review is and how is it different from audit, automatically a lot of aspects around it will be clear to you. Okay, now let's compare audit with review. So that's how we'll also try to differentiate between these two. See, review is actually what? Over here, we are not giving reasonable assurance, unlike audit. In case of audit, we provide reasonable assurance. Yes or no? But the assurance level in case of a review is lower as compared to audit. And that's why you call it as limited assurance, right? So you can say that's the first way to look at it. Now, while we talk about review, Let's look at as to what is it a practitioner will do in case of a review. See, sometimes for the historical financial statements, an audit may not be required. So the scope includes only a review. Now, by review, if you understand this term, you may be thinking that review means checking only. So, of course, review will involve checking, but the technical meaning of the review specifies some, or you can say certain procedures you'll perform in case of review. It's not something that you will have in case of a full-blown audit. We'll talk about that. Okay. Now, for the historical financial statements which are required to be reviewed, in such a case, what do you do? Let's look at the procedures now. Okay. Now, when you talk about review, and we'll also look at audit now because I think that's how you will get the clarity in terms of the difference. See, because you are providing limited assurance, that's why procedures you perform are what? Inquiries and analytical procedures. Or you can say substantive. Now, in this case, do we get into that control testing, substantive testing, something that you call as test of detail? Not really. Why? Because that's not the objective. That's not there in the scope. But does it mean that during the course of the review, if let's suppose the auditor wants to verify a particular document, wants to go through some of the contracts, so that will not be done, that cannot be done? No. So it's not about that. Of course, during the course of review, anything which the auditor believes is important for the purposes of review, that can always be considered therein, but please understand that's not really the scope. Okay, or that's not something you will always have in case of review. And that's why, because the procedures are limited, unlike an auditor will say that I'm not providing a opinion. Yes or no? So in this case, auditor will not be providing an opinion. By limited assurance, we mean to say auditor will be providing or giving a conclusion. Now, the way the conclusion is required to be given, we'll talk about that as well. Yeah, but understood that when it comes to a review, the scope is limited. Now, what do you have as the objectives? Obtain limited assurance, primarily by making an inquiry and performing analytical procedures. Okay, and then of course provide a review report. Now it will not be an assurance report, sorry, it will not be an audit report, it will be a review report. Correct? So that's the way you go about it. Now over here, because you will be doing a review, it means you are performing some sort of procedures. So will the auditor be required to get into some of those engagement acceptance compliances? Answer is yes. Those will be required. Okay. Those will be required here as well, right? Ethical responsibilities, independence, they all become important. Okay. Now planning again important. Why? Because for any procedures to be performed, without the planning, how do you think about it? So no, so that's why planning anyways is important. Yeah. Now, when you talk about inquiry, inquiry will include procedures related to first of all understanding. Okay, if there is anything which the auditor would want to understand in relation to the particular process, particular line item, or particular area which is the subject matter of the review. So that will of course be under. And in relation to those areas, auditor will be performing inquiries from the relevant personnel. Okay, in terms of the procedures which are performed. Right now, when it comes to analytical procedures, I think analytical procedures is something we already understand. When you do variance analysis or when you do analysis of some data, maybe on the basis of trend analysis, industry benchmarking, some of these procedures that you do, they are all examples of analytical procedures. But over here, substantive analytical procedures means something that you look at, you can always go refer a supporting document, because you're not only looking at the numbers, but at least something you are checking. Otherwise, what will happen? You will only be analyzing without the underlying document, which may not be appropriate. Okay. So that sort of consideration is important by the auditor to be included there. Correct. Now, this is what you have when it comes to the review primarily. But when it comes to a review, now what do you have? Again, it may vary. Why? Because depending on the scope, you will decide as to what is it you will want to do. And the conclusion, therein again, do you have modifications? Yes, the modifications could be there in the review as well. Correct. So let's try to look at both these points, and I think this is how we'll get the clarity in terms of what an audit is and what a review is. How do they stand against each other? Okay. Now, when we talk about review, so as compared to audit, the level of assurance is what? Lower. Yes or no? Why? Because when it comes to an audit, level of assurance is reasonable and which is considered to be high level of assurance, unlike review. When it comes to audit, what do? You will perform elaborate and extensive procedures. Test of control you will do, test of details you will do. What we discuss for a review, it will primarily be inquiries and analytical. Primarily. Okay. When it comes to audit, therein the opinion is given. But in case of a review, opinion is not possible. It's the conclusion which is given. Okay. And we'll see as to how the conclusion is given. Now, This sort of review may also be required for interim financial information. Now, what do you mean by interim? Now, this is something which is very common for listed companies. So, every quarter you see listed companies are required to produce their results, means the P&L part. So, is it a full blown of financial statements? No. Is it a complete set? No. And because it's interim, so that's why standard also provides a criteria as to what is it you'll have in case of interim financial information. Correct. Now, basis that, what may happen? A review for the same may be required. Excuse me. Why? Because when it comes to the full financial year, that's where you will do the audit. And for 3 quarters, let's suppose you are doing the review, right? So that could also be the approach which the auditor may be considering at times. Okay. Now here again, the similar set of engagement, acceptance, planning, and of course the procedures are required the way we discussed it. The other situation as well, wherein you go and check that. Okay. Now, I think to get some clarity on this, what we can do is we can just look at some questions. Okay, so just give me a minute. Let me just move on to the questions now. Yes, I'll just share the document and then we can discuss that. Right. Let me just pick up some of the questions from RTP first. Okay. Move on to the RTP. Right. So there we are. So let's look at this one. Yeah. E. Kanishk is an auditor of a company which is engaged in poultry farming and egg production. Sorry, I picked up the wrong one. Let's look at this. CA Amar has been approached by a company to undertake a review of its historical financial statements under SRE 2400. Okay. During the preliminary discussions, practitioner observes that certain key financial information may not be available. So that's one. Management has imposed restrictions on the scope of work. There are concerns regarding management's integrity and compliance with ethical requirements, including independence. So that's a serious concern. In the above circumstances, explain the factors affecting the acceptance and continuance of a review engagement. Okay, so that's one. Also, state the situations in which, unless required by law or regulation, practitioners should not accept the review engagement. So let's look at this, right? So let me just move on to the solution now. Okay. All right. So there we go. So as per SRE 2400, which is about engagements to review historical financial statements. Now, what is the requirement that you have? Practitioners shall comply with relevant ethical requirements, including those pertaining to independence, and engagement partner is responsible for overall quality of each review engagement. Okay. What are the factors that will affect the acceptance and continuance of client relationships? Unless required by law or regulation, practitioners shall not accept a review engagement if practitioner is not satisfied that there is a rational purpose for the engagement. Obviously, assurance engagements may only be accepted when the engagement exhibits certain characteristics that are conducive to achieving the practitioner's objectives specified for the engagement. Okay, it may be unlikely that there's a rational purpose for the engagement if, for example, there's a significant limitation on the scope of work, or the practitioner suspects association of practitioner's name with financial statements in an inappropriate manner. Similarly, when the engagement is intended to meet compliance requirements of relevant law or regulation, and such law or regulation requires financial statements to be audited, there is no rational purpose for such a review engagement. Okay, next, that a review engagement would be appropriate in the circumstances. Okay, when the practitioner's preliminary understanding of the engagement circumstances indicates that accepting a review engagement would not be appropriate, practitioner may consider recommending that another type of engagement be undertaken. Depending on the circumstances, practitioner may, for example, believe that performance of an audit engagement would be more appropriate than a review. Okay. In other cases, if the engagement circumstances preclude the performance of an assurance engagement, practitioner may recommend a compilation engagement or other accounting services engagement as appropriate. Okay. Or practitioner has reasons to believe that the relevant ethical requirements, including independence, will not be satisfied. That's fundamental, right? That practitioner's preliminary understanding of the engagement circumstances indicates that information needed to perform the review engagement is likely to be unavailable or unreliable. Practitioner has cause to doubt management's integrity such that it's likely to affect proper performance of the review, or management or TCWG impose a limitation on the scope of practitioner's work in terms of proposed review engagement such that practitioner believes limitation will result in practitioner disclaiming a conclusion. Okay. So I'll just move on to the next RTP. So this was May 26. Now I'll pick up September 25, right? There you go. Let's look at this. Yeah. Amar Projects Private Limited, a company involved in Turkey infrastructure, is in discussions for a strategic JV with a foreign company. As part of its due diligence process, foreign entity has requested a review of Amar Project's interim financial statements for 6 months period ended 30th September 24 instead of a full audit. Now over here it's the interim period and it's a review. Okay. To comply with this request, management appoints CA Tanvi, a practicing chartered accountant, to conduct the review and issue a report under applicable standards on review engagements. Before accepting the engagement, CA Tanvi is evaluating the scope of review, number one, nature of assurance, and appropriate format of her review. Okay. Now, what kind of assurance is given in a review engagement? How is it different from an audit? So that's one. What are the key elements that must be included in written review report as per SRE 410? Also explain whether a UDIN is required for such an engagement. Okay, yeah. So let's look at this. For a review engagement under SRE 2410, what do you find? Limited assurance, which is lower in scope as compared to reasonable assurance. Yeah, so that's the thing you have in case of audit, correct? A review consists of making inquiries, primarily of persons responsible for financial and accounting matters, applying analytical and other review procedures. Correct. A review may bring significant matters affecting the interim financial information to auditor's attention, but it doesn't provide all the evidence that you'll have in case of audit. Clearly, that's the limitation that you have. Yes or no? Now, what are the differences between audit and review? I think this is something that we have already talked about. So, in case of an audit, you have reasonable assurance, which is a high level of assurance. In case of a review, it's the limited assurance, which is lower level of assurance as compared to what you have in case of audit. Okay, so that's the first point. When you talk about an audit, so you can say extensive set of procedures are performed. What are those? So you'll have tests of control, test of details, analytical procedures, right? Something that you call as substantive test. But when it comes to a review, see, it's primarily, you can say it's something which will focus on inquiries and analytical procedures. So that's the thing you'll have, right? When it comes to assurance in terms of the audit. So therein it's the opinion which is provided. Unlike review, wherein the conclusion is given, opinion is not given. Okay. Now, in this case, auditor should issue written report that contains the following. So what do you have? Title to begin with, addressee, always. Then the identification of the interim financial information which is subject to review. Okay. If the interim financial information comprises complete set, statement that management is responsible. Okay. Then the auditor's responsibility. Then the statement about review in terms of its limitation. Now this para is important. Statement that the review of interim financial information was conducted in accordance with SRE 2410. Review performed by independent auditor, and a statement that such a review consists of making inquiries primarily of persons responsible for financial accounting matters and applying analytical and other review procedures. Statement that a review is substantially less in scope than an audit. Okay. And consequently doesn't enable the auditor to obtain assurance that the auditor would become aware of all the significant matters that might be identified in an audit, and accordingly no audit opinion is expressed, right? And then of course conclusion will be given as to whether anything has come to auditor's attention. Yeah, so that's the language. So you can say this negative wording is used. And then of course the sign off. Now let's talk about UDIN. Because the UDIN has to be generated and stated for uh, assurance engagement, so review being one of them, right? So that's why UDIN is mandatory in this case. Correct? Clear on this? Now, moving further. So, pick up this next RTP. So there you go. January 26 is the one that I have picked up now. So let's look at this. Yeah. More Limited has prepared prospective financial information for an upcoming expansion project. On review, auditor finds that basis of certain assumptions is not disclosed. So it's a review which has been performed. Yeah. Highly uncertain assumptions lack sensitivity analysis, and date of preparation is also missing. Right? Date of preparation is missing. Basis of certain assumptions is not disclosed. In addition, a recent change in accounting policy relating to revenue recognition has not been reflected. Okay. In this context, what should the auditor consider while assessing presentation and disclosure of prospective financial information and its underlying assumptions? right? So let's look at this. Excuse me. When assessing the presentation and disclosure of prospective financial information, in addition to the specific requirements of any relevant statutes, regulations, say any relevant professional pronouncements, it needs to be considered whether presentation of prospective financial information is informative and not misleading. Accounting policies are clearly disclosed in the notes. Assumptions are adequately disclosed in the notes. It needs to be clear whether assumptions represent management's best estimates or are hypothetical. And when the assumptions are made in areas that are material or subject to high degree of uncertainty, this uncertainty and the resulting sensitivity of results needs to be adequately disclosed. Date as of which prospective financial information was prepared is disclosed. Okay. Management needs to confirm that the assumptions are appropriate as of this date, even though underlying information may have been accumulated over a period of time. Okay. Basis of establishing points in a range is clearly indicated. And the range is not selected in a biased or misleading manner when the results shown in the prospective financial information are expressed in terms of a range. And if there is any change in accounting policy, okay, from that disclosed in most recent historical financial statements, whether the reason for the change, effect of such change has been adequately disclosed, right? So now moving further, so we'll pick up some more questions. Yeah, so let's look at this. Roma Limited has entered in a contract with Dorma Limited. There's a condition in the contract by virtue of which Roma is required to get its financial statements reviewed. Okay, so it's about a review for an year on a quarterly basis in accordance with financial reporting provisions of the contract. Can Roma Limited get its financial statements reviewed from a professional accountant in practice? See, the above financial statements are prepared in accordance with special purpose framework. Yes or no? When the financial statements are prepared as per special purpose framework, they can be reviewed, okay, by any professional accountant in practice. Right? Next. You are conducting a review of financial statements of a company. It is gathered upon inquiry there is a possibility of material misstatement in the financial statements. Discuss how you would proceed further in the matter. Okay. Now, if the practitioner becomes aware of matters, okay, around what material misstatement in the financial statements, So the practitioner shall design and perform additional procedures which are sufficient to enable the practitioner to conclude that the matter is not likely to cause financial statements as a whole to be materially misstated, or determine that the matter causes financial statements as a whole to be materially misstated. Additional procedures. Now, what do you mean by additional procedures? Those will focus on obtaining sufficient appropriate evidence to enable the practitioner to form a conclusion. Right? Now, what are these procedures? So, these procedures may be additional inquiry or analytical procedures. For example, being performed in greater detail or being focused on the affected items. Say the amounts or the disclosures concerning affected accounts or transactions are reflected in financial statements, or other types of procedures. For example, substantive test of details or external confirmations. Right? Next. During the review of quarterly results of a company of which you are the auditor, it is gathered on inquiries made there's been a major fire in fabric processing plant of a company during the quarter. It has resulted in massive disruption in the operations. Worse still, machinery and inventories were uninsured due to carelessness of concerned staff, leading to substantial losses. This matter has been disclosed in interim financial information appropriate. How would you deal with the same in the review? See, uninsured assets, they are examples of events or conditions, okay, about the significant doubt around going concern assumption. Okay. Now, if the result of inquiries, procedures result into this situation of material uncertainty around the going concern, so the auditor will have to report accordingly, right, in terms of the review report. Correct. Next. CA Seerath is conducting review of quarterly financial information of a company of which she is also an auditor. She believes it's necessary to make a material adjustment to quarterly financial information for it to be prepared in accordance with applicable financial reporting framework. She has communicated the same to CFO and the audit committee, excuse me. Excuse me. However, no response was received even after waiting for a reasonable time. Now, what are the options available to her? Okay. One, whether to modify, possibility of withdrawing from the engagement, possibility of resigning from the appointment to audit the financial statements. All of these factors she can consider. Next. Okay. Now, below is an incomplete draft text of review report on review of financial results of Fast Operations Limited. It's a listed company. Review is a compulsory requirement under SEBI regulations. So wherever there are incomplete areas, those have been marked as XX. Okay, so you start with the header, Independent Auditors Review Report. Then 2XX means to whom it is addressed. So that's missing. Then we have reviewed the accompanying statement, so and so. This para has been given. This statement, which is the responsibility of company's management, this para has been given. Our responsibility, this para is missing. We conducted our review in accordance with which standard, that is missing. A review is substantially what? That is again missing. Based on our review, So the outcome, the conclusion is, okay, using your knowledge, answer the following questions. So the first one, name of the addressee is missing from the text of draft review. Yes or no? That's what we looked at. Now, who will be the addressee in this case? Audit committee? No. Board? CFO, stock exchange. So I think clearly it has to be board. Correct? Next. Under para 2 of case study, choose the approach. So when they say our responsibility, so around that, what is the most appropriate language? Our responsibility is to express an opinion? Of course, no. Is it about reasonable assurance? No. Is it about compliance statement? Again, no. So what is that? Express a conclusion based on our clear? Yeah. Next. Given the description of the case study, which of the following engagement standards will be the most appropriate? SA 810, 700, do you think they will apply? But basis the information, it's interim. Is it historical financial statements? No. So that's why, what do you have? The only option that we have is A. Correct? Clear? Yeah. Next. Which of the following statements is most appropriate in relation to when you explain the review? Yeah, so this is interesting, huh? Because now you'll have to read this completely. Review is substantially broader in scope. Can we say that? No, this is clearly wrong. Review is substantially broader in scope. Can we again say that? No. Now, narrow in scope or less in scope? I think the better or the appropriate language is what? Less in scope. So that's why automatically, what do? The C goes off. So which is the right option? It has to be D. It has to be D. Clear? Excuse me. Let's look at the next one. So when you talk about conclusion, now what is the para you will give? Nothing has come to our attention that causes us to believe that the statement has been prepared in accordance with the recognition measurement principles. Okay. So that's one. Nothing has come to our attention that this statement laid down in Ind AS, okay, and the other accounting principles, it does not contain material misstatement. So this was off clearly. Again, this again seems makes the same statement. So this is wrong. Okay. Now true and fair view. Can you say that? No. Again, no. So that's why. What is the only option that you are left with? It's A. And that seems to be the correct one as well. Clear? Yeah. So with this, we are through in terms of our discussion. So thanks once again for your time today. We can just close this session now. Manish? Yes, done.